Just figured I'd give you an update. I've sent some posts for technical stuff that's been going on in the market. Lots of stuff going on. The real estate market, we'll start with that, of course. The real estate market is same old, 4.06 million home sale run rate in July. A slow, miserable slog as continues, with interest rates getting back up closer to 7 in the last week or two. Where we could continue to have some slowdown before the usual rebound in September and October, but we're in the August lull, so where everybody's getting ready for school, etc. So anyway, that's mortgage rates are rough, and likely the cause of the major shift, which has caused all of our indicators to turn dramatically in the last week or so, with the Federal Reserve still hesitating to move interest rates. So, there's the market's trying to say you should raise interest rates. The Federal Reserve's fortunately smart enough not to do that at this point until they get some more statistics. Tomorrow, some CPI data that's coming out, and so that will be interesting to see how that's shaken out. Likely to be pretty soft, actually, because last year's comps were pretty rough with all the tariffs, and they've got a lot of tariff refunds coming in. So anyway, the big news is the Treasury. The Treasury intervened in the Japanese yen. And you say, who cares? What does the Japanese yen have to do with our interest rates and anything else? But it does. It has been pushing up global interest rates as the Japanese yen has been weakening dramatically. And the Treasury Department, using the New York Fed, seem like they similar world, Treasury and Fed. They're pretty linked, and they're going to be linked as long as we are bankrupt when it comes to our deficit and such. So, but the Treasury sold euros, which the European governments did not appreciate, in order to buy yen when the Japanese Federal Bank also bought yen, and that took the yen from 167 or so yen to the dollar down to 155. Now it's squeaking back up to 158, 159, meaning that they wanted to strengthen the Japanese yen, which makes it so mortgage rates across our markets would possibly go down, but they really didn't go down as much as I think they hoped. But what it does show is that the Treasury is willing to liquefy the market and try to preserve any corrections in the stock market. There was a correction going on, blew up some a hedge fund, some young guy who thought he knew what he's doing. It wasn't even hedged, and blew up a multi-billion-dollar hedge fund, and so that liquidated a lot of the stocks. And that could have continued had the Treasury not intervened here. And so what that's told the market is that we really want to boom the economy and boom the stock market before the midterms, is the way I believe. It's what it says is, but regardless, what it does do is it puts a possible another bottom under the stock market, as well as potentially turning around gold. I might get a gold buy indicator, although it's a bit overbought right now. But with this, it shows that the dollar is going to be sacrificed for the sake of booming the economy. And so that's weakened the dollar quite a bit in the last couple of weeks, which makes gold, silver rebound, as well as stocks go up, worldwide stocks going up, emerging markets, et cetera. So that's put a bottom in the stock market for now. It's turned around. Our stock indicators are at 100% investment. So if you aren't 100% invested in stocks, what I've done is I'm legging back in. I bought a dramatic amount back in last week, and I'll be legging back in over the next week or so. So, but anyway, we did have a false indicator. So we lost some of the upside here, but that is the cost to pay. You're never going to be fully protected if you don't potentially sacrifice some gains at times. And the reason that I follow these indicators is to prevent a 30, 40, 50% loss, which I couldn't recover from given my age. If you're 25 years old, no big deal. Just stay long the worldwide stock market for the next 50 years and you'll be fine. But as you do want to reduce risk, but also you got to remember, if you take out the downside, because if you lose 50%, it takes a lot more to get back that amount. So you lose 50%, you got to have 100% return to get back. So it is better to protect your left tail risk so that you're not in trouble. And when you accumulate your gains on top of higher dollar amounts, your compounding ends up being higher. So anyway, it's the way like all the major hedge funds run their businesses, and it's something that the public has been told not to do, because if you trade on emotions, it is horrifically underperformed the market. As times I've wanted not to buy, I buy, and I realize why my emotions were completely wrong. So anyway, the buy indicator is 100% back into stocks. Gold is overbought, but I have one or two of my indicators that are showing positive on gold, and have for a week or two. But because I didn't have a confluence of all my indicators, I haven't mentioned it to you folks, because I don't want to. I want to be fully sure before I buy in as well. So anyway, up to you as to this is not financial advice, just information on what I'm doing, but. I wouldn't be surprised, because of the Treasury intervention, that gold starts a massive new move. It could happen, and if we turn around the volatility and momentum and all that stuff, we'll have a buy signal. But we'll see what happens here. So I'll let you know on that if that happens. So been interesting. The job market is bad. It's been bad for a couple years. The job report came out with a loss in jobs and huge revisions down. We are in a no hire, no fire economy still. Wages are not improving much, and that's where this K-shaped economy is a risk. I mean, we have the financialized market with the Treasury and the Fed helping those that own stocks and real estate make substantial gains, where the hourly worker that may not be able to contribute and be involved in stocks struggles. And I mean, that's why the Trump accounts exist. We're trying to get young people involved in stocks, because the economy is being financialized. So I mean, if the stock market were to correct dramatically, that would slow down the economy. It's now it is the economy in a way. But the AI boom build out is unbelievably powerful. It's pushing all types of profitability up to record highs. The circularity of the finance is also terrifying, but it's working, and these companies are making more money, although they're not making as much money as it appears because of the circularity of the finances, as we've talked about in prior videos. But the economy is pretty strong, although jobs are not. So we've lost, it's between 1 and 1.4 million full-time jobs, according to one of the surveys year to date. And so it is a tough market. A lot of people are driving for Uber or DoorDash or whatever, for Amazon part-time as a contractor. So there's a lot of jobs that really aren't being captured as full-time jobs and captured in this economy, because it's better to do that than to collect unemployment at the low payouts that you get for that, particularly in some states. So it is a interesting and difficult time to follow the market and to follow the indicators. We're going to get false alarms, and that's okay with me. Like I said, legging back into stocks, and I'm waiting for a buy signal in gold. And I did pick up some gold miners a few weeks ago, and that's turned out to be good, but it was a dangerous trade. But it worked out okay. But we'll see when all this turns. When it comes to the gold market, and I'll let you know if that happens. So anyway, weird market, real estate slogging along at a miserably low level for the fourth year in a row, and mortgage rates continuing back up, and August really slow, which it usually is, but we'll hopefully have a good September and October if we can get interest rates down a little bit. But we'll see with this Iranian standoff. It looks like Trump's going to wait them out and starve them out, which is a technique, maybe better, maybe not for me to comment on, but certainly interesting as to what's going on. But oil prices might remain to be strong, and that could keep interest rates a little bit higher. And it cause if the mortgage rate, or excuse me, if the interest rates go up substantially, that could cause some problems for gold too. So we'll see if that gold trade comes in. So that's all I got for now. Have a great rest of the summer, and back to school for the rest of your families. Good luck to you. Take care.